Alright, so hi guys, welcome to lesson 4. So in this lesson, you're going to learn how to size the position of your trades in order to manage your risk in a very low risk way, as well as how do you automate your trading orders so that basically you trade with very little effort and the results come a lot easier. So let's talk about position sizing. Position sizing is the part of your trading system that tells you exactly how many contracts to buy or to sell. Now, a trading system doesn't just take into account the entry rules and the exit rules. So some people may say, okay, I know exactly when to enter and when to exit, but if you don't size your position in a calculated way, it will not lead to a positive expectancy at the end of your trading journey. So recall that to be a successful trader, there are 3 things to take into account, right? You've got, first of all, your trading strategy that again tells you your entry and exit rules. But 30% of your success, that is even more important than the entry and exit rules, is how you size your positions to keep your risk per trade as small as possible. So in the event of a losing streak, which is inevitable in a trading system, you'll be able to continue trading in order to reap the positive edge that comes with it over a larger number of trades. Finally, you need to have, again, the psychology to execute the trades consistently. And we'll talk about that in a lesson on trading psychology. So for now, we're going to calculate, or we're going to focus on position sizing. So again, position sizing will help you to determine a few things. Number one, how many contracts do you go long or short on any particular trade? What is your risk per trade and your overall risk to your whole portfolio? And more importantly, what's your expected returns on your portfolio you can expect? So let's go through the steps to calculate your position size. And step number 1 is to check your net liquidation. So whatever broker you're using, once you log in, you can look at your net liquidation or the amount of capital that you have to trade, right? So we call this your net liquidation. And for example, say you've got $10,000, right? You open an account, you fund with $10,000, that's your net liquidation. Now you'll eventually go up, or you may go down first before going up, okay? Step 2 is you must determine your risk per trade. So risk refers to the maximum loss that you're willing to take for every trade you put in. This is the maximum you can lose if your stop loss is hit. Very importantly, this loss should never be more than 1% to a maximum of 3% of your net liquidation. Okay? In other words, never risk more than 1% to a maximum of 3% of your capital on any single trade. So my suggestion is to always start with a 1% risk per trade. And once you are confident enough, you're experienced enough, you can raise it to 2% and eventually to 3% maximum. Okay? Now, once you decide on your risk per trade, you have to stick to it consistently over a period of time before you upgrade it. Right? So what you never want to do is to say, okay, I'm confident in this trade. This is going to be a winner. I'm going to risk 3%. This trade, I'm not too confident, I'm going to risk 1%. No, it doesn't happen that way. You have to be consistent in your risk per trade because in reality, you never know which one's going to be a winner and which one's going to be a loser. Because on a trade-by-trade basis, every trade outcome is random. You got to remember that. You can never predict the outcome of any one trade. But you can predict the outcome of many trades that will give you a positive statistical edge of profit because the average wins will cover the average losses if you keep your risk consistent. So let's take an example where we start by risking 1% of our capital. So once you have that, step 3 is to calculate your position size for each trade. Now I'm going to show you how to calculate it manually, but in reality, there are many position sizing calculators that you can find online or on your phone app that will do it for you within a couple of seconds. So you have to understand the theory and then use the calculator, right? Great. So here's the formula. Okay? The number of lots to trade equals to your net liquidation or your current capital multiplied by your risk per trade, which is 1%, 2%, 3%, divided by your stop loss distance, multiplied by your dollar value per pip, per standard contract. Okay? So what do all these things mean? Let's put in examples over here. All right. So again, we're starting with $10,000 in our account, so net liquidation will be $10,000. We are risking 1% per trade, so we put 1%. So $10,000 multiplied by 1% is $100. So the most that you are willing to lose is $100 in a trade, okay? So how many contracts do you need to buy in order to keep that risk at $100? Well, you divide it by the stop loss distance, okay? What's the stop loss distance mean? Stop loss distance is the distance from your entry price to your stop loss price. For example, if you enter or you buy at say 1.2120, okay? So in Forex, we just say 2120, right? We don't say the 1 point, we just say 2120, right? And we place the stop loss at say 2100. Okay, now let me say, Adam, how do I know where to place the stop loss? That is what you're going to learn in lesson 5 and lesson 7. Under the specific strategy, I'll teach you exactly where to place the stop loss. Now, your stop loss placement is always based on the candlestick patterns. I repeat, you always place your stop loss based on certain candlestick patterns. So for different trades, your stop loss will be placed at different distances. Sometimes your stop loss may be 8 pips away. Sometimes it may be 20 pips away, depending on that price action. Okay? So in this case, let's imagine you're placing your stop loss 20 pips away. So this would be 20. Okay? Next, you multiply it by the dollar value per pip per standard lot. So what is this figure? Well, it depends on the pair you're trading. If you're trading Euro USD, then this would be $10. Okay, and other pairs would be, you know, slightly more or less than $10, could be $11, $9, and all that. So it depends on the pair. Okay, so how do you find out what this figure is? I'll show it to you in a short while. You can go to many websites to check the dollar value per pip, or just use a standard calculator that will calculate everything for you. Got it? Great. Oops, sorry. So yeah, so once you punch in these numbers, 10,000 multiplied by 1%, divide by 20 times 10, you will get 0.5. So the answer is 0.5. So what is 0.5? 0.5 means 0.5 contracts, or sorry, 0.5 lots, if you will. Now recall in lesson 1, one standard lot in Forex is 100,000 of the base currency. So in this case, the base currency is Euro USD. The base currency is Euro, right? So one lot is 100,000 euros. So 0.5 lots would be 50,000 euros. Okay, so that's exactly the number of euros that you will buy to place this trade. Okay, so notice that in your account, you've got $10,000 in cash, but you're buying 50,000 in euros to take this position. So how much leverage are you using? You're using roughly about 5 times leverage. Okay, so you find that in Forex trading, we will use leverage. Some brokers will offer you 40 times leverage, 100 times leverage. You don't need that. In fact, in most of my trades, I only leverage a maximum of 20 times. That's the most. In other words, if I've got a $10,000 account, okay, the very most that I'll buy is 20 times of that, which is 200,000. Yeah, 200,000, right? But in this case, it is 5 times leverage, only buy 50,000. Okay, let me say, hey, isn't that risky? You know, I only got 10 grand, I'm buying 50 grand, right? No, it's not risky because you've got your stop loss there. So the worst that can happen is that you lose $100, right? Because you're risking 1% of your net liquidation. So your risk is not 50,000, don't freak out. Your risk is $100, okay? Because of the stop loss. That's why you gotta place a stop loss, right? Okay. Okay, so let's take a look at another example. So in this example, again, let's go through the steps. Step 1, determine your account equity or your net liquidation, right? So again, imagine you got $10,000 in your account. You've funded your account of 10 grand. And step 2 is you're going to determine your risk per trade. So in this case, let's imagine you're going to risk 3% of your capital. Because you're more confident, more experienced, you can put 3%. Again, once you upgrade to 3%, you can't go back. You've got to keep being consistent with that same 3%, right? So this means in a losing trade, you are prepared to lose 3% of your capital, which is $300. Step 3, determine your stop loss distance. So again, like I mentioned, this depends on the strategy and the specific candlestick pattern that you see. So in lesson 5 and lesson 7, I'll teach you exactly where to place a stop loss for any particular trade. So in this case, let's imagine your stop loss is 30 pips away. Okay? So with that information, you can calculate the number of lots to trade. So number of lots would be, again, net liquidation, which is 10 grand, multiplied by 3%. Divide by stop loss distance of 30 pips, multiplied by your dollar value per pip. So again, this depends on the currency pair. Now for most pairs which are US dollar denominated, it's about $10, right? So Euro USD is about 10 bucks. So you're just going to use 10 bucks. So 10,000 multiplied by 3%, that's $300. Divide by 30 pips times $10, 300 divided by 300 is one lot. So one lot is again 100,000 of the base currency. So if it's Euro USD, base currency Euro, we're going to buy 100,000 euros. And if you do that, and your stop loss is at 30 pips, how much is your risk? $300. That's it. Okay, so a few important points to note. Now, remember that regardless of where you place your stop loss, whether you place your stop loss 10 pips away, 20 pips away, 100 pips away, your risk should always remain the same. Where you place your stop loss should not change the risk you're taking. That's the key. You must always be risking a fixed 1% of your capital or 3% of whatever it is. Okay? So depending on the strategy and the specific candlestick pattern of that trade, stop loss is placed at different distances, usually below the previous low of the candle. Okay? So you always determine your stop loss first. Then you calculate the number of lots to trade to keep your risk consistent. The number of lots traded is inversely proportional to the stop loss. In other words, the further your stop loss, the smaller the number of lots you trade. The nearer the stop loss, the greater the number of lots you trade, with the risk always being the same. Alright, so this is just one of the many position sizing calculators that you can use when you are calculating your position size. And again, I tend to use the one that I download on my phone app, but I'll show you the one on one of the websites. So if you go to myfxbook.com /forex calculators position size, okay, just simply do a Google search for forex calculators position sizing, you get something like that. Okay, so again, account currency US dollars, account size. Now this will be your net liquidation. So in this case, it's say 10 grand. You're risking again, say 3%. Your stop loss is 30 pips away. Choose the currency pair you're trading, okay, because this will determine the dollar value per pip. So if you're Euro USD and click on that, boom, there you go. One lot, which is 100,000 units. There you go. So simple as that. Alright, so alternatively, you could use the position sizing calculator indicator that I've created especially for my students. And again, you can download the indicator from the website and install it into the MT4 folder, which I'll show you how to do in a short while. So once you've installed into the folder, you can actually call it out in the MT4 charts. So let's see how it's done. So the first thing to do is to go to Insert Indicators, all right, and go down to Custom Indicator, and it should appear there. So Position Sizing Calculator version 1, Piranha Profits. Again, you have to first install it into the folder, and it will then appear over here. Okay, so click on that. So once you click on that, you will have this box over here. And all you got to do is to key in the entry price, stop loss price, take profit price, and your risk per trade. And you automatically calculate the number of lots to buy based on your account size. Okay, so for example, right now the price is at about 9966. The market's closed right now, so it's just an example. So let's imagine you want to enter at 9967. That's your entry price. Okay, so what you got to do is to click on the value here, 0.9967, for example. That's your entry price. Stop loss. Let's imagine, place your stop loss 10 pips below the entry price, so that's 0.9957. Okay, next put in your profit target. Say it's 20 pips above the entry price, so 0.9987. That's right. Okay, next put in your risk per trade, and again your risk per trade should always be consistent. All right, so for example, again, if it's 2%, put 2%. If it's 1%, put 1%. So once you've done that, click OK, and this box will appear. Okay, this box will appear over there. Now, at the same time, you will see 3 lines appearing. So that's the first line. So this blue line over here is the entry price, 9967, stop loss at 9957, and the profit target is at 9987. Right, now you can't see that because it's somewhere above, so I'm going to zoom out slightly. There we are. Okay, so again, that's your green line over here, 9987, profit target. Profit target, entry price, and stop loss. Okay, now what's really cool about this indicator is that it will immediately calculate your account balance. So in this case, my account balance is $74,975. Okay, and again, as you know, if you go to view, terminal, you can see your account balance is over here. So in this case, again, it's $74,975 US. So this indicator is really smart because it will immediately read your account balance and put it here for you. All right, and again, you will risk 1% of your account balance, right? And it will show you also your risk to return ratio. So in this case, we are risking 1 to 2, right? So it's 1 to 2, and it'll tell you how many lots to buy. So in this case, based on a 1% risk per trade, I'm risking 1% of my account balance. So my actual risk is $749. So that means I can buy 7.47 lots. Okay, so I'm going to click new order, and there, 7.47 lots. That is the amount I buy. Now, if you want, you can also adjust your stop loss and your entry price. So for example, if you feel that, hey, I want to put my stop loss closer, right? You could, you want to put it closer, you could double click on it, drag it. So notice as you drag it, if I drag it up, for example, what's going to happen? Notice the stop loss changes based on where I've dragged it to, okay? And now again, the risk to return ratio, because my stop loss is closer, my 1R is smaller. So based on the profit target, I'm now getting 1:3. Yeah. At the same time, I could also shift my profit target downwards, right? So I can double click on the green one. I could drag it down, all right? Drag it down, and straight away you can see now my profit target is a new price, and my risk to return ratio is 1:1.8. So again, you can play with it by, again, manually changing your stop loss, entry price, and take profit from this window, or you can just drag it from here. So that makes it really cool. And again, you automatically calculate your account balance and put it over here, and you'll calculate your risk per trade and tell you exactly how many lots to buy. So in this case, based on this one, I'm buying 4.7 lots. So just key in here 4.7. All right, so that's pretty cool. So that's how it works. All right, so in case you do not know how to install indicators into your MT4 platform, this is how it's done, right? So the first thing is to, of course, download the indicator. So over here, I've downloaded it. All right, you can download it from our website under the resource section. Okay, and then what you do then is you go to your application folder on your computers. So application, and under application, you would look for your broker's icon, right? So for example, at this point of time, I'm using Halifax brokers, but I've changed my broker based on some unfortunate reasons. Okay, but anyway, so this was the broker I was using, Halifax Pro. So what you do is you, again, you go to the icon of your broker, whether it's IC Markets or whatever it is, right? Or Oenda, right? So you right click and go to Show Package Contents. Click on that and go to Drive C. Go to Program Files. Go to MT4. Go to MQL4. Go to Indicators. All right, and it was a big mouthful, so you have to rewind it and watch it slowly, right? So in this folder, you have all the indicators that you can put in, right? So again, in this case, I will put in the position sizing calculator, drag and drop it in. There we go. So once it's in there, close it, and then close your MT4 platform. You have to close your MT4 platform by, again, closing it. Okay, and then restart again. All right, so once it's restarted, again, it should immediately appear over here. All right, if it doesn't appear, again, go to Insert, Indicators, Custom, and go to your calculator, click, and boom, it should appear. Key in the values, and you will have the box appear there. So that's how it works. All right, so let's take a look at some graphical representations of what I've just mentioned. And again, for example, on the left, you can see a long trade where you are entering at a certain level. So for example, you're entering at 1.20, okay? So say you're entering at that level of the Euro USD. So you place your stop loss 10 pips away. So that will be 1.2010. Now in Forex, we just say 2020 and 2010. We don't say the 1 point something, right? So clearly it's 10 pips below. So again, I've mentioned again and again, let me just say it again, where you place your stop loss depends on the specific candlestick patterns of that particular strategy. And we'll learn that in the strategy section of lesson 5 and lesson 7 of this professional Forex trading course. Now, so if your stop loss is at 2010, this 10 pips represents your 1 hour distance. So again, what is R? R represents risk, okay? And so if I'm risking 1 hour, my profit target will be usually 1.5 hour, okay? When I trade stocks, I tend to use 1:2, but when I trade Forex, especially the way I trade Forex, I trade 15-minute candles, right? I'm doing day trades or scalping trades. I normally will take a 1.5 hour target. And the reason I do that is because Forex is a lot more volatile. And I find that when I take a 1 to 2, it doesn't hit my profit target as much as I want to. It reduces the win rate. So with 1.5, I get a very, very high win rate and a very good profit at the end of the day. So I say, don't be greedy. Don't always go for the 1 to 2, 1 to 3. At times it works, but most of the time, if you're trading regularly, a 1 to 1.5 is really very, very profitable. And I learned not to be greedy in trading currencies, especially trading lower time frames. Okay, so if 10 pips is 1 hour, 1.5 hour, just take 10 multiplied by 1.5, it's 15 pips. So I know that my target price will be 15 pips above the entry price, which would be 2035. There we go. Okay, and in the lesson plan on placing orders, what I do is I place a bracket order with the entry, stop loss, and target price placed at the same time. Okay, so there we go for this example. Now, over here, it's a different trade. and I'm entering at, again, say, in this case, say I'm trading the dollar yen, so it's 111.30, for example. Okay, I'm going long on the dollar yen. Okay, so my stop loss in this case be 20 pips away because of that specific candlestick pattern or strategy. So my stop loss would be 111.10. Okay, so in this case, my stop loss is further away from this one, but the risk should still be the same. Not should, must be the same. So it is still 1R. So when I size my position, in this case, I would buy so-called a different number of contracts from this one. This one, my contract size will be bigger. This one, my contract size will be smaller in order to maintain the same risk of my capital. Okay, so if I'm risking 20 pips, my target price must be 1.5R above the entry. 1.5 times 20 is 30 pips. Target price at 111.60. There you go. So again, no matter where you place your stop loss, your risk per trade remains the same. And your target price is always 1.5 times your risk. All right? All right, so let's review our rules one more time. Risk management ensures that you keep your losses small and you will always have enough equity to keep trading in the event of a losing streak, which is inevitable in trading. No matter how good you are, you go through periods of winning streaks and periods of losing streaks. And you got to ensure that when you go through a losing streak, it doesn't wipe you out. It keeps you in the game. All right? So here are the rules again. Rule number 1, always risk a fixed percentage of your net liquidation or capital. Again, cap it between 1% to a maximum of 3%. Remember, when you risk 1%, if you get 4 losses in a row, that's a 4% drawdown on your capital. At a 3% risk per trade, with 4 losses in a row, you're getting a 12% drawdown on capital. But if you risk 10%, which you should never do, yeah, right? Remember, 4 losses in a row and you're down 40% of your capital. Now, you may say, hey, but Adam, if the trading strategy is good and I keep trading, I'll make that money back. Yeah, that's true. But I can tell you that for most people, once they lose more than 20% of their money, it affects them psychologically. They get emotionally affected. And you know, the moment you get emotionally affected, your fingers start to shake and it's like, should I take the next trade? What if I lose again? And the moment you get emotional, you can't trade at your peak. So you must always risk a small percentage such that a number of losing trades does not affect you at all emotionally. Right? In fact, if it affects you emotionally, it means you're trading with too much risk. Always trade at a level of risk where it doesn't affect you emotionally, and only then can you trade optimally. Make sense? Okay, great. So again, always use a stop loss order. Never enter a trade without a predefined stop loss. A stop loss allows us to predetermine the amount that we can lose in a losing trade. Okay, let me tell you the difference between amateurs and professionals. Amateurs, when they enter the market, they have got this gambler's mentality. They always dream of how much money they can make. Oh, this one's going to be a big win, I'm going to make so much money, right? Professional traders, whenever we place a trade, the first thing we think about is not how much I'm going to make. The first thing we're going to think about is how much am I prepared to lose if this trade is a loser. Because any trade that you go into could be a loser. You never know which one. So the only thing you can control is how much you can lose per trade. So you always keep that really small. Next, always use a take profit order. Well, that's my style at least, okay? Because that allows us to predetermine the profit in a winning trade. Remember, you can only make money at the end of the day if your average win is more than your average loss. You can't control your win rate, but you can control how much you win when you win and how much you lose when you lose. And by having a predetermined profit target, you can ensure that you always get more than 1 hour of risk. So when you lose 1 hour. When you win, you have to win more than 1 hour. 1.5 hour is my style for Forex. Okay? So again, ensure your risk to return ratio is at least 1:1.5. And again, trading success is balancing between win rate and risk to return ratio. Some people say, Adam, why don't I risk 1 to make 2 or risk 1 to make 3? Isn't that better? Sure, who doesn't? But the moment your profit target is too far away, your win rate will go down. So there's always a trade-off. And to me, this is the ultimate balance, right? Which is risking 1 to make 1.5 and having a pretty decent win rate of about 60% to sometimes 70% win rate. Okay. So again, remember, the better the risk to return ratio, the lower your win rate. Okay. If you risk 1 to make 5, you can't get a 60% win rate. Your win rate may go down to only 30 to 40%. Okay. Few other important rules. Now, this is my own rule. I suggest you follow it, right? If you want to trade like me, is I do not take more than 2 concurrent trades at the same time. In fact, most of the time, I only take 1 trade. Only when it closes do I take the next trade. And the way I trade Forex, I trade 15-minute candles, so my average trade lasts for 1 to 2 hours or less. All right. In fact, I rarely hold a trade for more than 2 hours. So it's a day trading scalping style. I don't take more than 2 trades at one time, because when I take a trade, I'm risking, say, 2%. If I take 2 trades, I'm risking 4%. Okay, so no more than 2 trades at one time. And if I am taking 2 trades at the same time, they cannot be correlated. What do I mean? For example, if I go long Euro USD, what does it mean? It means I'm bullish on the Euro and bearish on the dollar. And if I take another trade and I'm shorting the dollar yen, which means now I'm bearish on the dollar, okay, I'm bullish on the yen. You know, both trades are correlated, because over here I'm bearish on the dollar, right? And I'm also bearish on the dollar. So if the dollar goes up, both trades will lose. That's not a good idea, right? Next, I take a maximum of 3 trades every day. Okay, now there's no minimum. On certain days, if there's no clear trade setup, I do not take a trade the whole day. Even I can look at the charts the whole day. If there's no clear trade, I do not take it. That's the discipline. I only take high quality trades and a maximum of 3 trades a day. All right. So now that you understand about how much risk you're taking when you're trading, the next thing is you have to know how much you can potentially earn as a professional or part-time Forex trader. So the idea is to always ensure eventually you can make as much money in your trading as compared to your job. So you can eventually, quit your job and do this full-time, or still keep your job and double your income. That's a good idea, right? Okay, great. Now to do that, you have to determine what is the expectancy of your trading system. Your trading system must have a positive statistical expectancy and edge in the markets, right? So in the trading course, I'm going to teach you the trading systems that I use that have got a very high profit expectancy. Now, not every trade is going to be a winner, but you can be sure that over a sample of trades, you will always make money, okay? And from there, you can calculate your expected return a month and in a year. So whenever you trade a strategy, you must always calculate the expected profit per trade. And this is the formula. The formula goes this way: is percentage win multiplied by average win minus percentage loss multiplied by average loss. Okay, so depending on your strategy. So the strategy I use is called the impulse pullback and the impulse pin bar strategy. It's got a pretty good win rate of about 55 to 60% on average. Now, sometimes I can get a 70% win rate on certain months, but let's be conservative and let's just take a 55% win rate, okay? So based on this, you can expect to win 55% of the time and lose 45% of the time. So we have to plug in your average win and average loss. So let's take an example. So let's imagine you risk 1% per trade. So your average loss would be $100, right? 1% times 10 grand. And your average win would be 1.5%, right? Because you're risking 1 to make 1.5 in Forex, remember that? So your average win would be $150. So if that you plug in the figures, what do you get? So your expectancy per trade will be 55% times 150, which is your average win, minus 45% multiplied by $100, your average loss. So if you do the math, that's $82.50 minus 45, that's $37.50 per trade. So on average, every trade you make will get you $37.50 on average, right? That's statistical average. So this means that if you do 20 trades a month, 20 trades multiplied by $37.50 is $750. And $750 over 10 grand, that is 7.5% return per month. Okay, so if you compound that 7.5% a month, compound in a year, it's over 100%. You're doubling your money every year. Now I can tell you that in reality, the figure is a lot higher than this. Why? Because this assumes that your capital is always at $10,000. Remember, it will not always be at 10,000. From 10,000, it will grow to 11, 12, 15, 20,000, and your average win will be bigger. Well, so will your average loss. But your average money, profit per trade, will be bigger and bigger. So it compounds. So this assumes there's no compounding, right? Now, the other way you can do, the other thing you can do is as you get more experience, you risk more than 1%. You risk 2% or 3%. And again, if you risk 3%, what happens? Your return per month from 7.5% will triple to over 16% a month, and it compounds from there. Now, one of the most important things that I've learned is to not think in terms of money when I trade, because money is a very emotional thing, right? So if you think in terms of money and you have a loss, you say, I just lost $200. I just lost, I just lost 10 meals, all right? Or I just lost a TV set, all right? I just lost an iPhone, right? I just won a holiday, right? And you get very emotional, okay? So the key is to always think in terms of our multiples, right? What does that mean? So successful traders always think in our multiples, so they mentally disassociate with the money they're trading, okay? So what is 1R? 1R is a unit of risk. So again, 1R is the maximum risk you're taking per trade. So 1R could be 1% risk or 3% risk. So the key is that when I have a loss, I never think I lost, $5 grand or $500, $50. I always think, no, I lost 1R. I just lost 1R. And when I win 1.5R. So that's how I think. And at the end of the month, at the end of the year, I then tally the money I made, which is always positive, right? So if you use our multiples to calculate your expectancy, here's how it look, right? So same thing. Your expected profit per trade will be 55%, which is your win rate multiplied by your average win. And your average win is 1.5R minus your percentage loss per trade, 45%, multiplied by 1R average loss. If you do the math, you get 0.375R per trade. Okay? So on average, every trade you make, you're going to make 0.375R. As long as it is a positive figure, your trading system has a positive expectancy in the markets. Okay, so again, if you do 20 trades a month on average, now I do anywhere from 20 to about 40 trades a month for currencies, all right? Trading on the 50-minute candles. So that's 7.5R a month. So again, what's 7.5R? If you're risking 1% of your capital, 7.5R is a 7.5% return on your capital. Risk 2% is 15%, risk 3%, it's 22.5% return on your capital. Let me say, okay, if that's so great, why don't I do this immediately? Because the volatility be a lot higher, right? Remember, when you get 4 losing trades, at 3% risk is a 12% drawdown. And you must be mentally conditioned, emotionally to handle that. So always start with 1% and work your way up from there, okay? All right, so let's take a look at this trading simulator that was created by a very good friend of mine, and this friend of mine, his name is Kyung Hee, and to this day, he's the best forex trader that I know in the world. All right, and he's a brilliant guy. He started with $10,000 and grew to $1 million US in about 2 to 3 years or less. All right, and he's one of the best traders I know, really dear friend, and he created this simulator, and I've provided as part of this online forex trading course, so you can use it and you can see what kind of results you expect or results you can expect to get as you trade your currency markets. Okay, so I'm going to show you how it works, and basically this uses an Excel random number generator. Okay, so what you want to do is you want to key in the boxes in yellow. Okay, key in the boxes in yellow, and you'll compute the different outcomes you can expect, right? So the first thing is to key in your win rate, okay? So I can tell you again, the trading systems that I will teach you in my course, the win rate would be, again, roughly about 60%, okay? But I would say conservatively, you can, aim for anything between 50% to say 60% win rate. On good months, you can get a 70% win rate, but let's not get carried away. That can't happen every month, okay? So let's begin with putting in an average of 55% win rate. So key in 55%, enter. Now, can you see simulated win rate over here that says 51%? Okay, so notice every time I key in 55, I will get a different figure. Different figure. Why? Because this is a simulation based on random number generators. Let me give you an example, right? Now, if I toss a coin, what is the theoretical win rate of a heads? 50%, right? 50% heads and tails. But if I toss it 100 times, I don't always get 50 heads and 50 tails. Sometimes I may get 60 heads and 40 tails, or I may get 40 tails and 60 heads. So every 100 times, there's always a difference depending on the luck factor, randomness. So this accounts for the random win rate over 100 trades, as you can see. Okay, so every time you trade 100 trades and your strategy has a 55% win rate, you will get a different result depending on the randomness. Does it make sense? Okay, great. So put 55%, and for the losing R multiple, put 1 and 1. So this is the minimum loss and maximum loss. We always keep it as 1R, right? Because we always place our stop loss and we always lose 1R when it hits our stop loss. We always honor the stop loss. Never ever remove the stop loss. Okay, unless you want to die. Don't die. Okay, great. Now, for our winning R multiple, again, I set a profit target at a fixed 1.5R. So 1.5, 1.5. Minimum max. I make it really simple. I keep my life really, really simple. Okay. Risk per trade, again, you can start with 1%, 1%. So once you key in these variables, you can then put in your starting capital. So again, imagine it's 10 grand and enter. And based on those variables, you can expect to see your 10 grand go to $14,000, okay, over 100 trades. 100 trades. So how long do you need to complete 100 trades? Well, it depends on the trading strategy you use. So again, the trading strategy I use is called the impulse pullback and the impulse pin bar, based on 15-minute candles. And I do anywhere from 20 to 40 trades a month. So if you take the average of 25 trades a month, basically I do 100 trades every 4 months. So basically you're achieving 100 trades in 4 months, all right? And in 1 year, it's about 300 trades, okay, in a year, all right? So, so notice every time you put in 10,000, all right, you get a different figure, right? Notice. You will always get a different figure. Why? Why is it always different? Because, like this is low. Why? Because this keeps changing. Like in this case, the win rate drops to 47%, and hence, you only grow your capital to 11 grand. Now, put another one. Okay. Okay, so in this case, you get the win rate goes up to 59% for that 100 trades. Your compounded return is 59%. Money goes to 59% in 100 trades, which again is about 4 months, all right? And you can see that based on this, what is your expected profit per trade, 0.48 R, your standard deviation, and so on and so forth, right? And you can see how your capital grows, and your capital compounds from 10,000 to, in this case, $15,000. And again, notice it's not a straight line, right? Your capital can't go up every day, right? There's ups and downs. There will be losing streaks, okay? So if you look at the 100 trades over here, notice, right? Even with a win rate of 59%, you will get 1, 2, 3, 5 losses in a row. It will happen, right? You will get 4 losses in a row. But at the same time, you will get 1, 2, 3, 4, 5, 6, 7 wins in a row. So the losses can come in a row, the wins can come in a row. Okay, so the point is this. Many people say, hey Adam, you know what, I love to do what you do. I love to get 59% win rate, a 59% growth in my capital in 4 months. I want to double my money. Sure, you can do that, right? When you follow my system, you can do that. But to do that, you must be willing to walk the journey of going through the wins and losses. Most people are not willing to do that. Some people, like, for example, imagine you start trading. And it so happens when you start trading, you happen to capture this losing sample. Is that possible? Yeah. Where 1, 2, 3, 4, 5, 6, you take 7 trades and you lose 6 and you win 1. Now, most people at that point of time would give up. They say, oh, frick, this doesn't work, right? They go do something else. They go trade options or something like that, right? Or they start to, lower their risk, or they start to tweak their strategy, and it all gets screwed up, okay? Or they lose confidence, they stop trading. But what if you started trading and you happen to capture this winning sample over here, where you 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. You had 10 trades, you win 8, you lose 2. And say, wow, my win rate is 80%. You get carried away and you start to risk more and more, right? And by the time you risk more, the losing streak will come. So my point is, in trading, all right, when you have a win, don't be happy, all right? When you have a loss, don't be upset, okay? Because every outcome in your trading is statistically insignificant. And I'll talk a lot about this again under the trading psychology section of this course. But I like to just keep saying it again, to drill within you that you do not be concerned with losing and winning streaks. What you're concerned about is the outcome over 100 trades, which will always be positive if you follow the system, okay? And again, notice if you risk 3%, what happens? If you risk 3%, what happens to your capital? Boom, right? It gets higher, right? 3%. You can see on average your ending capital is higher, right? You make more, the more you risk. But when you risk more, what happens? You find that your drawdown, your worst drawdown becomes 20%. Drawdown is your drop in capital, right? So with a higher risk, you got to take a higher level of drawdowns, okay? So that concludes this section on position sizing, risk management. Okay, so let's go on to the next section.